Something massive is happening in the silver market, and it's not just another price swing. We're talking about a fundamental shift that could change everything we thought we knew about the white metal. What's unfolding right now, in early 2026, is a perfect storm of policy changes, supply shortages, and extreme volatility that's turning silver into one of the most dynamic and uncertain markets on the planet. Let's start with the epicenter of this earthquake, China. On January 1st, 2026, Beijing rolled out a new export control system that has completely reshaped the global flow of silver. Now, Chinese exporters need a government-issued license to ship silver abroad, and only large, state-approved companies can even apply. This effectively locks out small and medium-sized refiners from the international market. Why is this such a big deal? Because China controls a staggering 60 to 70% of the world's refined silver supply. This isn't just about the silver they mine. It's about their dominance in refining high-purity metal that's essential for electronics, solar panels, and electric vehicles. This isn't a minor regulatory tweak, it's a strategic move. China is now treating silver less like a commodity and more like a critical national resource, prioritizing its own booming tech and industrial sectors over export profits. The immediate result? A sudden, sharp tightening of silver availability for the rest of the world. This policy shock couldn't have come at a worse time. For years, the silver market has been heading towards a structural deficit. Soaring demand from green technologies like solar energy and EV manufacturing was already outstripping the world's ability to supply new metal. We were consuming more silver than we were producing. Now, add China's export restrictions to the mix, plus a steep drawdown of silver inventories in major vaults, and you don't just have a tight market, you have a serious supply squeeze. We're seeing reports of Chinese warehouse inventories hitting decade-low levels as physical metal gets snapped up. Demand is still red hot, both from industries that need it and from investors looking for a safe haven, but the physical supply is dwindling fast. Naturally, this chaos has led to insane price volatility. Since late 2025, we've watched silver prices rocket toward all-time highs, only to come crashing down in dramatic sell-offs. One of the reasons for these wild swings is forced liquidation. When prices move so quickly, leveraged traders get wiped out, creating a domino effect. We've even heard about one huge Chinese trading firm that made hundreds of millions by shorting silver during one of these sharp corrections. This back and forth action, with massive rallies followed by brutal pullbacks, has left even seasoned traders feeling dizzy. The stress is also showing up in the futures market, specifically the COMEX run by the CME Group. There are growing concerns that COMEX inventories are being rapidly depleted. Physical silver is being pulled out of Western vaults and shipped to places like China and India where the real demand is. Some analysts are now warning that the link between the paper price of silver and the actual physical metal is starting to break. In a futures market, you're mostly trading contracts, not metal. But what happens if buyers demand delivery and the metal simply isn't there? The odds of a delivery stress event, or even a default on the COMEX, are higher than they've been in a very long time. This isn't just theory. We can see the documented movement of metal out of exchange warehouses. The physical silver is on the move, and the ripple effects are spreading everywhere. Silver is a critical industrial metal. For companies making solar panels, electronics, medical devices, or EV batteries, this supply crunch means higher costs. Those costs will eventually get passed on to consumers, or could even lead to production slowdowns. In a fascinating twist, even central banks and sovereign wealth funds are reportedly getting in on the action, quietly adding silver to their reserves alongside gold. They see it as a hedge against currency risk and geopolitical instability. At the same time, major consumer brands that rely on silver, like the jewelry maker Pandora, are already announcing plans to reduce their dependence on it, looking for alternative materials. That's how you know the problem is real, when entire industries are forced to change their business models. One of the most important developments in 2026 has been the growing divide between the paper price and the physical price of silver. In China, where physical delivery is the norm, the premiums paid for actual metal have diverged significantly from the benchmark prices set in Western markets like London and New York. What this means in simple terms is that the price you see on your screen for an ETF or a futures contract might not be the price you pay to get your hands on a real silver bar or coin. That gap between paper and physical is now one of the most closely watched indicators in the entire commodities world. So, what does all this mean for the future? We are witnessing a new paradigm for silver. This is not a temporary market correction. It's a structural reengineering of the entire global market. We have powerful supply constraints driven by Chinese policy. We have extreme volatility as traders struggle to price in this new reality. We have relentless industrial demand from the green revolution. And we have a dangerous split opening up between the physical and paper markets. The coming months are likely to bring even more volatility, tighter supplies, and maybe even a whole new way of discovering the true price of silver based on where the real metal actually changes hands. This story is far from over. Have you been watching the silver market lately? If not, you need to be. What started as small ripples in late 2025 has turned into a full-blown storm, and it's shaking the foundations of the global economy. This isn't just about prices going up or down. We're talking about an unprecedented period of turbulence that could redefine silver's role for years to come. And at the center of it all, a shocking emergency action from China. Let's break down what's happening. In early 2026, China dropped a bombshell on the global silver market. They rolled out strict new export regulations. Suddenly, any silver leaving the country needs government approval, and only a few state-authorized refiners are allowed to ship it. Why is this such a big deal? Because China isn't just a player in the silver game, they are the game. They supply a staggering 60 to 70% of the world as refined silver, the same silver that powers our phones, our solar panels, and our electric cars. By slamming the brakes on exports, China is effectively telling the world, our silver is for us now. They're prioritizing their own massive domestic needs, especially in technology and green energy. This isn't just a simple regulatory change. It's a strategic power move. It screams that silver is now a critical geopolitical resource, just as important as oil or microchips. Global traders who once relied on a steady flow of Chinese silver are now left scrambling. The message is clear. The days of freely available Chinese silver are over. This couldn't have come at a worse time. Even before China's big move, the silver market was already walking a tightrope. We were in a structural deficit, meaning we were using more silver than we were mining. Think about it. The green energy revolution is in full swing. Solar energy, electronics, and EV manufacturing are booming, and all of them are incredibly thirsty for silver. Demand was already outstripping supply. Now, with China turning off the tap, the tightrope is snapping. Inventories in major hubs like London and New York are plummeting. We're hearing reports that silver warehouses in China are at their lowest levels in a decade. This isn't just a problem for big-shot traders. The ripple effect is hitting everywhere. Industrial users in the United States, Europe, and India are facing a harsh reality. They're being forced to pay huge premiums just to get their hands on physical metal, and some are even having to delay production. A shortage that started in one corner of the world is now causing a global supply chain nightmare. So, what happens when a critical commodity suddenly becomes scarce? Extreme price volatility. In the first few months of 2026, the silver market has been on a wild roller coaster. We've seen breathtaking rallies driven by pure supply panic, followed by brutal sell-offs as leveraged traders were forced to liquidate their positions. It's a speculator's dream and a long-term investor's nightmare. And guess who's been capitalizing on this chaos? According to some reports, a few savvy Chinese trading firms have been riding these waves, reportedly netting hundreds of millions of dollars as prices swung back and forth. This has created one of the most uncertain and dangerous trading environments for silver in decades. Everyone, from industrial giants to small-time investors, is left holding their breath, trying to guess where the market will lurch next. The tension is boiling over into the futures market, too. On exchanges like COMEX, a huge disconnect is growing between the price of paper silver, the futures contracts, and the price of actual physical silver you can hold in your hand. This is a classic sign of a market under extreme stress. Physical metal is being drained from Western warehouses to meet the desperate demand in Asia. This leaves a mountain of paper contracts that might not be fully backed by deliverable silver. Imagine holding a ticket for a sold-out concert, only to find out the venue has half the seats they promised. That's the fear here. This could lead to a delivery bottleneck, where futures contracts simply can't be settled with real metal because it isn't there. This gap between paper and physical is a ticking time bomb, and traders are watching it obsessively. Where it goes from here could dictate the next major price explosion. Let's not forget why this matters to you. Even if you've never bought an ounce of silver, silver is everywhere. It's in your smartphone, your laptop, the solar panels on your neighbor's roof, and even in life-saving medical devices. The electric vehicle industry is completely dependent on it. And when supply gets this tight and prices soar this high, it's not just an abstract problem. It means higher production costs for manufacturers. It could slow down the production of everything from electronics to green technology. Ultimately, these costs will be passed on to us, the consumers. The price of your next phone, your next car, even your electricity bill could be affected. We're already seeing some jewelry makers cutting back on silver, and on the other side of the coin, we're hearing whispers that central banks and sovereign wealth funds are quietly adding physical silver to their reserves as a hedge against currency volatility. When the big money starts moving, you know something significant is happening. One of the most telling signs of this crisis is the spike in physical premiums. This is the extra amount you have to pay over the spot or paper price to get actual physical silver. In Asia, these premiums have gone through the roof. This tells you that the demand for real, tangible metal is overwhelming the paper market. For investors who are holding physical bars and coins, this is a very different ballgame than for those invested in ETFs or futures. This divergence is also creating huge opportunities for sophisticated traders who can play the arbitrage game between different markets and forms of silver. So, where do we go from here? The silver market in 2026 is in a state of controlled chaos. To summarize, we have severe supply constraints thanks to China's new rules. We have record-breaking volatility across both paper and physical markets. We have relentlessly strong industrial demand, especially from the tech and green energy sectors that are shaping our future. And we have a growing wave of investors diversifying into physical silver as a safe haven. The coming months are almost certain to bring more of the same: more uncertainty, more dramatic price swings, and more strategic shifts from both industries and investors. This is a story that is far from over. It's a complex situation with no easy answers, and it's crucial to stay informed. As a final note, please remember, this video is for educational and informational purposes only. It is not financial advice. The markets are extremely volatile, so always do your own research and consider consulting with a qualified financial professional before making any investment decisions. Hold on to your seats, because the silver market is experiencing a seismic shock, and what's happening right now in early 2026 is sending shockwaves across the entire global economy. We're talking about unprecedented price swings, surging industrial demand, and a bold emergency move from China that is completely redrawing the map. Traders, investors, and even major manufacturers are all scrambling to figure out what comes next. It all started in January 2026. China, a powerhouse that dominates nearly 2/3 of the world's refined silver supply, suddenly clamped down on its exports. From one day to the next, any company wanting to ship silver abroad needed explicit government approval. The rules were simple: only a select group of state-authorized refiners could sell internationally. This instantly sidelined countless smaller producers, effectively cutting them off from the global market. Why would they do this? The answer is strategy. China is signaling a massive shift, treating silver not just as a precious metal for investment, but as a critical industrial commodity, vital for its own growth. By prioritizing its domestic industries, China has intentionally created a global supply squeeze, and the effects have been immediate and dramatic. Now, it's important to understand that the silver market was already on shaky ground. For years, we've been in what's called a structural deficit. This means we were already using more silver than we were mining. Think about where silver goes: solar panels, electric vehicles, smartphones, and all kinds of advanced electronics. The demand from these booming sectors was already draining inventories worldwide. China's export restrictions were like pouring gasoline on an already raging fire. Suddenly, the existing shortage became a full-blown crisis. Global buyers, from tech giants in Silicon Valley to car manufacturers in Germany, found themselves with limited access to the physical metal they desperately need. Warehouse inventories have plummeted to their lowest levels in over a decade, and this scarcity has sent premiums, the extra cost you pay to get your hands on actual physical silver, skyrocketing. This supply shock has unleashed a level of volatility we haven't seen in years. Since the end of 2025, the price of silver has been on a wild roller coaster. One day it surges on fears of a shortage, the next it crashes as leveraged positions are suddenly liquidated. This extreme environment has become a playground for highly capitalized speculative traders. We're hearing reports of some trading firms making hundreds of millions of dollars in a single day by riding these chaotic price swings. But for the average investor, this isn't a game. It's an environment of extreme, unpredictable risk. The rapid gains and losses highlight just how unstable this market has become, making it incredibly difficult for anyone to navigate. And this brings us to a critical pressure point: the disconnect between paper silver and physical silver. Much of the world's silver trading happens through futures contracts on exchanges like COMEX. These are essentially promises for future delivery of the metal. But here's the problem. A huge amount of physical silver is leaving Western vaults and heading to Asia, where the demand and premiums are highest. This is creating a dangerous gap between the number of paper contracts out there and the actual deliverable silver available to back them up. Experts are watching this situation with hawk-like intensity. If a large number of contract holders suddenly demand delivery of physical metal, and the vaults can't provide it, we could face a massive delivery bottleneck. Such an event could trigger a crisis of confidence in the entire paper market, leading to even more explosive volatility. The ripple effects of this silver squeeze are spreading far beyond financial markets. Remember, silver is a workhorse metal. It's essential for technology, renewable energy, and even medical applications. With tight supplies and rising prices, the cost of producing everything from solar cells to advanced medical equipment could increase. This could slow down the green energy transition and make everyday electronics more expensive for consumers worldwide. At the same time, we're seeing some fascinating strategic shifts. Central banks and sovereign wealth funds, institutions that manage national reserves, are quietly increasing their silver holdings as a way to diversify away from traditional assets. Even the jewelry industry is being forced to adapt. Some producers are reducing the silver content in their products or scrambling to find alternative materials. This just goes to show how a disruption in one commodity can cascade through dozens of unrelated industries. One of the most significant outcomes of China's policy is the widening chasm between physical silver and paper silver pricing. In Asia, the premiums for physical bars and coins have gone through the roof. This means an investor holding a physical silver bar in their hand could see its value appreciate very differently from someone holding a silver ETF or a futures contract. Why? Because those paper assets aren't always backed one-to-one by physical metal in a vault you can access. This growing divergence has ignited a huge wave of interest in physical accumulation strategies. More and more investors are choosing to buy tangible assets like coins and bars, opting for allocated storage where they own specific identifiable metal. For sophisticated traders, this price gap also creates arbitrage opportunities, the chance to profit by buying silver in one market and selling it for a higher price in another. So, what does the future hold for the silver market in 2026 and beyond? One thing is certain: the landscape has fundamentally changed. We're facing a new era defined by several key trends. First, persistent supply constraints driven by China's strategic industrial policy. Second, continued extreme volatility across both physical and paper markets. Third, incredibly strong and inelastic industrial demand, especially from the green technology and electronics sectors that simply cannot function without it. And fourth, a clear shift in investor behavior, with a growing preference for physical holdings and a search for alternative assets to hedge against uncertainty. We should all prepare for continued price instability, higher premiums for physical metal, and potential shifts in global supply chains as manufacturers and investors adapt to this new reality. The silver shocker of 2026 is a story that is far from over, and its outcome will shape our world for years to come. As a final note, please remember that this video is for informational and educational purposes only. It is not financial or investment advice. The markets are extremely volatile, so always do your own thorough research and consider speaking with a qualified professional before making any financial decisions. Thanks for watching, and if you found this breakdown helpful, be sure to like, subscribe, and hit the notification bell so you don't miss our next update.